At 94 years old, Warren Buffett revealed a quiet confession, one that shook the very foundation of what many of us thought we knew about retirement and investing. It wasn't shouted from the rooftops. It wasn't packaged in Wall Street jargon. No, it was simple, unsettling, and powerful. Since crossing the threshold of 70, the Oracle of Omaha has narrowed his focus to just 3 kinds of assets. Only 3. And here's the shocking twist. None of them match the shiny formulas Wall Street has been selling for decades. Forget the so-called 60/40 portfolio. Forget the endless cycle of rebalancing charts, target date funds, and age-based asset allocation models. At 70, Buffett tossed the entire traditional retirement playbook into the fire. And what he did instead? It could completely change the way you see your own financial future. This is not just any investor making a contrarian move. This is Warren Buffett, a man who grew up during the Great Depression, who endured 15 recessions, who has seen empires rise and fall, and who has navigated more market cycles than any living investor. By the time he was 70, he wasn't just wealthy, he was legendary, sitting atop a fortune of over $30 billion. And yet, at that exact point, when most people would simply protect what they had, Buffett chose to reinvent his entire approach. Why? Why would someone who had mastered the game, who had already won by every measure, suddenly change everything? Because Buffett had discovered a truth that most investors don't realize until it's too late. After 70, the game of money is no longer about chasing growth. It becomes something else entirely. It's about survival, about dignity, about building something that outlives you, about finally earning the right to sleep peacefully at night instead of refreshing your portfolio in quiet panic every morning. And here's the part that matters for you. Buffett's approach isn't reserved for billionaires. The same principles can be applied whether you're 30, 50, or already retired. Today, I'm going to walk you through exactly what those 3 assets are, why Buffett turned to them in the final chapter of his career, and how you can begin adopting this timeless strategy in your own life. The first one? Cash-generating monopolies. Not mere stock certificates, but entire machines of cash flow. You see, most people think Buffett simply buys stocks. That's a myth. After 70, he stopped being content with slices of companies. He began buying the whole pie, entire businesses that people cannot live without, no matter the season, no matter the political climate, no matter the state of the economy. Look at his landmark move in 2009. BNSF Railway, a $26.5 billion acquisition, the largest in Berkshire Hathaway's history. Not a tech startup, not a flashy growth company. A railroad, a business that quietly hauls nearly half of America's freight, rain or shine, in recession or in boom. Every single day, those trains move, and every single day, they generate billions in steady cash flow. And that's just one example. Berkshire Hathaway Energy, serving millions across multiple states. Precision cast parts producing the essential components that keep aircraft engines in the sky. These aren't speculative plays. These aren't assets you buy to flip. They are cash machines built to endure, designed to last. These are not just investments. They are income-producing assets, the kind that throw off steady, predictable cash every single quarter. Year after year, decade after decade. That's the difference. They don't just look good on a statement, they put money in your pocket while you sleep. Last year, I met a retired engineer from Detroit who understood this principle better than most. Instead of leaving his entire nest egg trapped in mutual funds, riding the daily roller coaster of the stock market, he made a different choice. He purchased a small apartment building in a blue-collar neighborhood. Nothing glamorous, no glossy brochure, just bricks, mortar, and tenants who needed a place to live. That building now delivers $3,200 in rental income every month, no matter what the stock ticker says, no matter if the market is climbing or crashing. For him, it's not just about profit, it's about peace of mind. He sleeps soundly because he owns something real, something tangible, something necessary. And that is exactly what Buffett realized after the age of 70. Stock market gains are numbers on a screen, fragile, fleeting, capable of vanishing in a single bad week. But cash flow? Cash flow is what pays for groceries, medicine, and healthcare. Cash flow is what allows you to cover unexpected expenses without fear and to maintain dignity in retirement. Cash flow buys you freedom. The key insight here is control and necessity. Buffett wasn't interested in speculation anymore, or in hoping the crowd would push share prices higher. He wanted to own assets that serve fundamental, inescapable human needs: transportation, energy, housing. These are not passing fads. They are the foundation of life itself. Trains will keep running. Homes will always be needed. Lights must stay on. These are the things that don't go out of style and can't be disrupted by the latest app. And here's what this means for you. Think beyond the traditional portfolio. Explore dividend aristocrats companies that have raised their payouts relentlessly for more than 25 years. Consider properties that the modern world cannot live without. Medical office buildings, apartment complexes, even data centers humming with the energy of the digital age. Maybe even a side business or a small rental property that generates income whether Wall Street is smiling or sulking. The question is not, will this make me rich quickly? That's the wrong game. The right question is, will this pay me reliably when I can no longer work? And that brings us to Buffett's second asset, perhaps the most boring and yet the most brilliant of them all. Government-backed insurance flowed a seemingly dull strategy that became, for Buffett, a golden wellspring of wealth. Buffett called it float. At first glance, it sounds abstract, almost technical. But at its core, it's one of the most powerful financial engines ever created. Here's how it works. Imagine getting paid by customers to hold their money and then being able to invest that money freely without paying a single cent in interest until the day you finally need to give it back. That's float. Through Berkshire's insurance companies, millions of policyholders send in their premiums every year. Those billions flow into Buffett's hands immediately. And while many of the claims won't need to be paid for years, sometimes even decades, that money doesn't sit idle. It's invested, working 24 hours a day, compounding quietly in the background. It's like being handed a limitless loan at 0% interest while being paid to borrow it. For Buffett, it was a boring miracle. Now, you might be thinking, that's fine for billionaires running giant insurance firms, but what about the rest of us? Here's the secret. The principle matters more than the vehicle. Buffett wasn't obsessed with flashy returns. He was obsessed with certainty, guaranteed yield, safety, predictability. And that mindset is accessible to everyone. Take Treasury I-bonds, for example. Anyone can buy up to $10,000 per year directly from the government. They're built to fight inflation. They're 100% safe. And right now, they pay over 5% annually. No brokers, no fees, no sleepless nights wondering if your money will vanish. Or consider CD ladders. Instead of locking up your savings in one certificate, you spread them across different maturities, maybe $20,000 in a one-year CD, another $20,000 in a two-year, and so on. As each matures, you roll it over at the new rate. The result? A steady stream of predictable income, protected against the ups and downs of interest rates. I once spoke with a retired teacher from Ohio who created her own version of Buffett's float. She took $200,000 from her 403(b) and placed it into a guaranteed income annuity. From that moment on, she receives $1,100 every month for the rest of her life. No market swings, no fear of outliving her savings, just certainty. Even certain life insurance contracts can play this role, providing guaranteed cash values while passing wealth to the next generation in a tax-advantaged way. It's not exciting. It's not the stuff of Wall Street headlines, but that's exactly the point. Boring is beautiful when boring means certainty, and Buffett, after 70, valued certainty above all else. But float was only the second piece of his puzzle. There was still one more asset class, perhaps the most misunderstood of all, that he turned to in his later years. And this final piece reveals more about his philosophy than numbers ever could. The real lesson isn't about a specific product or investment vehicle. It's about a shift in mindset. Buffett, after 70, stopped chasing yield like a gambler at the roulette wheel. Instead, he began securing guaranteed returns backed not by speculation, but by the full faith and credit of institutions that simply cannot go bankrupt. At 50, at 60, at 70, you don't need home runs anymore. You don't need to swing for the fences. What you need are base hits, consistent, reliable, predictable returns. Returns that let you sleep peacefully at night, knowing your foundation is steady, unshakable, rock solid. And this brings us to his third, and perhaps most surprising, choice. An asset you'll never see listed on a brokerage statement. An asset no financial advisor will put in your retirement portfolio. Yet, in Buffett's later years, it became the most powerful wealth-building tool of all. Reputation capital, the ultimate moat. Unlike stocks or bonds, reputation can't be bought with money. It doesn't earn dividends you can chart on a graph. Yet it compounds faster than any stock you'll ever own. Trust, credibility, integrity. These are Buffett's final investments, and they have returned more than billions ever could. Every shareholder letter he wrote, every interview he gave, every simple piece of wisdom he shared, these weren't just acts of generosity. They were deliberate investments in his greatest intangible asset: his name, his word, his reputation. Think about it. When CEOs face crisis, who do they call? Warren Buffett. When companies need emergency capital, whose door do they knock on first? Buffett's. When investors panic in the middle of a market storm, whose voice do they wait to hear? Buffett's. His reputation opened doors that remained permanently locked to almost everyone else, no matter their net worth. And this principle isn't just for billionaires. A financial advisor I know in Phoenix understood this early. Instead of pitching products, he began writing a short newsletter each week, offering practical insights to local business owners. No sales tactics, just real value. Over 15 years, his audience grew to 8,000 readers. Today, he doesn't chase clients anymore. They chase him. His reputation, built one insight at a time, became his most valuable marketing tool. But reputation capital goes far beyond business. It's about becoming the person others turn to for wisdom, guidance, and perspective in your field. Maybe you're a seasoned engineer mentoring younger colleagues. Perhaps you're a manager who distills years of lessons and shares them at industry conferences, or a master craftsman teaching apprentices the skills you've spent a lifetime perfecting. Your reputation becomes leverage invisible on a balance sheet, but powerful enough to open doors and create opportunities for decades. And like Buffett, you'll discover that when money fades, reputation is the true legacy that endures. Wealth can buy you a seat at the table, but reputation? Reputation keeps you there and opens doors you never even knew existed. It invites partnerships, sparks opportunities, and creates income streams that don't depend on whether your body is strong enough to keep working. And the beautiful truth about reputation capital is this: it's never too late to start. Whether you're 45, 65, or even older, you already hold decades of experience, stories, scars, and wisdom that others desperately need. The real question is, what value are you offering that no market crash can erase, no inflation can devalue, and no recession can strip away? Start writing down what you know. Share the lessons you've earned through struggle and success. Build relationships that go beyond transactions. Because those are the assets that will outlast any chart, any number, any balance sheet. Here's the deeper wisdom most people miss about Buffett's post-7-0 strategy. It was never truly about the assets themselves. It was about what those assets protect. They safeguard your time. They preserve your dignity. They maximize your choices. And, most of all, they secure your legacy. When you're in your 30s or 40s, you can afford to chase growth. You can take risks because mistakes can be repaired with more work, more time. Your greatest wealth in those years is your human capital, your ability to earn. But after 70, the equation changes. Time becomes your scarcest resource. Buffett didn't want to gamble with volatility anymore, because at that stage, every dollar is more than money. Every dollar is freedom. Freedom from worry, freedom to spend time as you choose, freedom to support the people and causes that matter most. And look at how each of his three chosen assets carries value beyond his own lifetime. The railroads and utilities he acquired will serve millions of people for generations to come. His businesses will keep spinning off cash flow that fuels charitable giving long after he's gone. His insurance float will protect families against catastrophic losses for decades. And his reputation? It will continue to guide, influence, and inspire investors long into the future. This isn't retirement planning. This is dynasty thinking. Buffett didn't just secure his personal comfort, he designed a legacy meant to ripple across time. Each asset serves three purposes at once: income, legacy, and meaning. And yet, this wisdom isn't reserved only for billionaires. I think of my grandfather, who spent 35 years in a steel mill in Pennsylvania. He never owned shares of Berkshire Hathaway. He never built sprawling empires. But instinctively, he practiced the same timeless principles. He bought a modest duplex, lived on one side, and rented out the other. He kept his savings safe in government bonds. And in his town, he became known as a man of his word, a man people could trust with both their money and their hearts. When he passed away at 89, that little duplex was still sending rent checks to my grandmother. Those bonds continued to provide steady income. And his reputation? It opened doors for his children and grandchildren that might have stayed forever closed otherwise. That's the true power of these assets. Not just wealth, but dignity. Not just income, but legacy. Not just numbers, but meaning. The lesson here is not that you must become the next Warren Buffett. It's not about trying to copy his every move or dream of billions that may never come. The true lesson is to think beyond money itself, to think beyond the number in your bank account, to begin building assets real, lasting assets that serve not only you, but also your family, your community, and even generations you may never meet. We've just explored Buffett's three pillars of wealth. But pause for a moment. Ask yourself, are you starting to see your own financial strategy in a new light? Does this approach feel more stable, more secure than the endless stress of chasing the market, trying to guess the right timing, or jumping from one hot trend to the next? If it does, type "makes sense" in the comments. Because when you write those two words, you're not just agreeing, you're declaring to yourself that you're ready to shift how you think about money after 40. And I'll tell you this, I read every single comment. I learn from your stories. I'm moved by your perspectives. This is not theory. This is life. Now, let's make it practical. Because I know what you're thinking, this all sounds inspiring, but I'm not Warren Buffett. I don't have billions to buy railroads. I don't own insurance companies. How do I apply these principles with what I actually have? The answer begins with what I call the cash flow monopoly strategy. Instead of sitting back and hoping your retirement account grows fast enough to outpace inflation, begin seeking assets that pay you consistently, no matter what the market is doing. Think of dividend aristocrats. Companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. For more than 25 years straight, through recessions and recoveries, they've raised their payouts year after year. That's stability. That's resilience. Or consider REITs, real estate investment trusts. A medical REIT like Medical Properties Trust owns hospitals and clinics that remain full whether the economy is booming or struggling. Digital Realty Trust owns the data centers that keep our internet and our lives running every single day. They may not sound glamorous, but they are essential, and they typically return 4 to 7% in annual dividends. And maybe you're ready to think bigger. A friend of mine bought a modest laundromat in a working-class neighborhood, $150,000. Not small, but not impossible. And do you know what it returns? After expenses, about $2,000 a month in passive income. Clean clothes are a basic need. He didn't need to be an expert. He just needed the courage to own something simple that people will always require. But cash flow is only one part. The second principle is government-backed security. Stop gambling with risky junk bonds. Stop chasing unsustainable yields. Build your foundation on guarantees. Series I bonds protect against inflation and are currently paying over 5%. Treasury bills can be laddered to give you steady, predictable income every few months. Even a fixed annuity, for those nearing retirement, can guarantee monthly income you cannot outlive. Yes, it sounds boring compared to crypto or the excitement of growth stocks, but boring is what works when you're protecting decades of your life's work. And finally, the most overlooked investment of all, your reputation. Think about it. What expertise have you quietly built over 20, 30, even 40 years that others desperately need to learn? Don't let it stay locked in your head. Document it. Write articles on LinkedIn about your insights. Mentor younger professionals. Speak at community events or local business groups. Every word you share, every relationship you build, adds to your reputation capital, a currency that cannot be stolen by inflation or destroyed by market crashes. Because reputation outlives wealth. And when combined with cash flow and security, it becomes one of the strongest assets you can ever leave behind. Mentor the younger ones stepping into your field. Share the wisdom you bled for. A retired police sergeant I know does exactly this. He began consulting small businesses on security protocols. Nothing flashy. No Wall Street backing. Just decades of lived experience. He charges $150 an hour and is busier than he ever imagined. Why? Because his reputation precedes him. He's known as a man who delivers. And in retirement, that reputation became his strongest asset. Not just for money, but for purpose, for impact, for meaning. And that is the hidden truth. Your reputation can become the greatest retirement investment you'll ever make. It can generate income, open doors you didn't know existed, and give you fulfillment that money alone could never buy. But now, let me give you the warning. The part Wall Street desperately hopes you never figure out. Because Buffett's post-7-0 strategy, it threatens their entire machine. Think about it carefully. If you buy quality dividend stocks and simply hold them for decades, your broker earns one commission once. If you put money in treasury bonds or CDs, banks pocket minimal fees. If you buy a modest rental property and quietly collect rent for 20 years, no advisor skims a management fee. If you build a reputation, if you consult, teach, mentor, share, suddenly you're generating value directly, and nobody on Wall Street takes a cut. That's their nightmare. Because their entire business model depends on your movement, your panic, your doubt, your constant urge to adjust. They want you trading, rebalancing, chasing hot stocks, fiddling with allocations. Every move, every shuffle of your portfolio feeds their machine. They want you checking your account daily. They want you sweating when markets fall. They want you buying protection in the form of complicated products you don't even understand. Fear is their business model. Anxiety is their profit center. Buffett chose the opposite path. Buy quality, hold forever, collect cash, ignore the noise, sleep at night. He turned his back on the circus, and in doing so, he robbed Wall Street of their favorite customer, the restless, anxious investor. And I have seen it firsthand. Too many men and women in their 50 seconds and 60 seconds who had already done the hard part. They had built wealth, saved diligently, invested wisely, and yet, advisors convinced them they needed to optimize. They sold off the boring, reliable returns. They chased exciting but fragile opportunities. And in doing so, they lost decades of work. Here's the hard truth. Most people approaching retirement don't need to optimize. They need to preserve. They don't need home runs. They need base hits, steady and reliable. They don't need to beat the market. They need to outlast it. That was Buffett's real insight after 70. The shift wasn't just in his portfolio, it was in his relationship with money itself. He moved from accumulation to preservation, from growth to cash flow, from hoping to knowing. And that is the quiet revolution that Wall Street will never market to you, because there's no profit in it for them. But for you, it could mean everything. Because the three assets we've explored, cash-generating monopolies, government-backed securities, and reputation capital, they are not just categories on a balance sheet. They are shields. They are pillars. They are what protect your freedom, your dignity, your choices, and your legacy in the years when time, not money, becomes the scarcest resource of all. They are not just assets. They are pillars. Pillars holding up a life of dignity, freedom, and purpose when the years are no longer measured in decades, but in moments that truly matter. And here's the part so many miss: you don't need billions to begin. You don't need to be Warren Buffett. You need clarity. You need the courage to take the first step. Because you can start building steady cash flow today. You can lock in guaranteed returns this very week. You can invest in your reputation, in who you are, and how you serve others, starting right now. The best time to plant a tree was 20 years ago. The second best time is today. Every choice you make from this moment forward shapes not only your own future, but the inheritance of wisdom, stability, and strength you leave to those you love. So ask yourself, what will your 70 seconds look like? Will they be marked by worry, noise, and restless chasing? Or will they be defined by calm, by confidence, by the quiet power of knowing your foundation cannot be shaken? Your future self and your family will thank you for making this shift before it's too late. Now I want to hear from you. On a scale of 1 to 10, how valuable was this breakdown of Buffett's post-7-0 investment strategy to your own financial journey? Share your rating in the comments. I read every single one. And your insights not only guide me, they may also spark a change for someone else who needed to hear your voice today.